Hi, I'm Matt Martindale at America's Mortgage, a division of Cherry Creek Mortgage, with a quick mortgage minute. I've been fielding a ton of calls lately asking me what's going on with interest rates in the market and why is everything changing so fast. I want to take a minute to chat about how the mortgage market really works, coming from Barry Habib at MBS Highway. He's arguably the world's premier expert and the smartest guy on the planet when it comes to understanding this. Essentially, a borrower goes to somebody like me, a loan officer, to obtain a mortgage. Once a loan is closed, it is passed on to a servicer. Now, the key is the servicer may or may not be the same company that you actually did the loan with. The servicer does not own the loan. Rather, they just maintain it. They'll do things like collect payments, pay taxes and insurance, maybe do an escrow analysis, as well as answer your calls and questions. All these loans are bundled and sold as pledged security for things like mutual funds, retirement accounts, annuities, and pensions. Just remember, for every seller, there has to be a free market buyer. Now, this is going to be key coming up. The servicer's role is critical to making the whole mortgage market work. The servicer will typically pay about 1% of the loan upfront for the right to collect the monthly payments over the life of the loan. Their break-even period is about 3 years. Think of it like leasing a car. Now, that being said, they don't own the asset, they just have the right to actually service it or collect those payments. The longer a loan is on the servicer's book, the more money the servicer makes. The servicer has the responsibility, though, to make the payment to the investor, in this case, maybe the insurance company or whomever bought that pool of mortgages, even if they've not received the payment from the borrower. This runoff creates large losses. Now, once interest rates drop dramatically low, everyone wants to refinance all at the same time. The servicer has an enormous amount of loans that are being paid off that haven't reached that 3-year break-even point yet. The pipeline then fills with new and cheaper loans at a lower interest rates. This, combined with forwarding payments on an asset that they may not even have received payments on, creates massive losses. Although it is true that about $6 trillion in loans could benefit from a refinance, the nation's capacity is about $2 trillion. This is actually pushing up some lenders to push up the risk of market volatility onto borrowers by maybe extending locks to 60 days or radically raising interest rates to slow that pipeline down just a little bit. Now, perhaps some lenders are not allowing borrowers to actually lock in their rates until they've gone through the whole underwriting process and are just 15 days from closing. In part 2, I'm going to talk about why some believe that the Federal Reserve's desire to bring mortgage rates down in the coronavirus crisis isn't only hurting the servicer and their crucial role, but maybe how it's hurting the lender's ability to be able to manage risk in the future. So if you want to talk mortgages, let's chat. Depending on your situation, I might be able to help by eliminating debts, maybe lowering a payment or giving you some cash cushion during these turbulent times. Once again, I'm Matt Martindale. Contact me. I'd love to chat.